Good day, ladies and gentlemen, and welcome to our class on what are indicators. Now, indicators work for both the Forex market, the crypto market, stock market, gold, oil, CFD trading. Now, I would appreciate it greatly if you would kindly click on the subscribe button or the bell icon down below. I promise you we're not going to bother you with anything except when I upload a video, you'll get a notification, but that's it. Now, technical indicators are a field of technical analysis. A lot of traders don't understand that technical analysis is a very, very large, broad field. And technical indicators like RSI, MACD, Bollinger Bands are only one little field, and they are called technical indicators. Okay. Now, indicators are meant to do three things. They alert, they predict, and they confirm. A technical indicator is a mathematical calculation that can be applied to an asset's price patterns, like price, volume, or even another indicator, to come up with a mathematical value. That value then can be analyzed. Technical indicators do not analyze any part of the fundamental business, like earnings or revenue or economic data. Jobs report doesn't care about elections. They are numeric calculations. Technical indicators are most extensively used by active traders in the market, as they are primarily designed for analyzing short-term price movements. To a long-term investor, most technical indicators have no value at all. Now, charts, ultimately your price chart is the story of price. It is, and the price on a chart is the final decision maker. It is the ultimate speaker, so to speak. But there are times that your charts are not speaking the same language you are, and you need help from an interpreter. Technical indicators are the interpreters. Technical indicators do not remove you from price action. They don't guarantee you anything. Ultimately, you have to depend on price action. But they look at price information and translate it into simple, easy to read signals that can help you determine when to buy or sell an asset. A technical indicator offers a different perspective from which to analyze the price action. Some, such as a moving average, are derived from simple formulas, and the mechanics are relatively easy to understand. Others, such as stochastics, have complex formulas and requires more study to fully understand and appreciate. Now, I'm going to try to give this in some type of an example or a story, and it may be a little off base, but I kind of want to let you try to get you to grasp the ultimate concept. We all know what the United Nations is. Okay. And we all know when the United Nations has a general meeting, there's hundreds of people representing hundreds of countries all sitting, in their auditorium listening to a speech, a presentation, whatever it could be. Most of those people have no common language. Now, granted, we know English is the predominant, but a lot of these people don't speak English. Those that do may not have a very good grasp of English, or they may understand UK English better than they understand American English. But the presenter is speaking in his own language. Now, let's say the speaker is from Belgium and he's speaking French. Now, I'm from Paris and I speak French. Another guy is from the Dominican Republic and he speaks French. They all speak slightly different variations of French. And in general, in an open conversation, they could understand each other to a degree. But in a presentation where you want to understand all the ins and outs and all the innuendo of what somebody's speaking or saying, you need some assistance. You need an interpreter. So you put on your headset and you have an interpreter from your home country who's also excellent in French and your language, who is interpreting live the speech and the presentation is being given up on stage. It's an extremely involved skill. Okay, translating a document is easy compared to live translation because the words are coming out of somebody's mouth and they have to be going into somebody's ear simultaneously, and not all the words are exactly the same, and you need to understand the syntax, the innuendo, and the cultural words that are correct for you. So it's very, very difficult. Now, because I'm from Paris and I speak French fairly well, and I speak to enough people from Belgium all the time, and we converse just fine, I don't need the A top level interpreter. Okay, well, I can use a B or a C level, but when I pick my interpreters, I'm the ambassador, I'm the representative of the UN. I have a whole slew of interpreters that I use. Okay, and I pick them, they get trained, because my ear also has to be comfortable with their voice, their tone. And then I also understand the translators and how they're translating and what their strong points are and what their weak points are. But I don't want somebody with a voice at a level that is bothering my ears, or a voice with a cadence that isn't comfortable to me. So these are what technical indicators are. They're all different. They're all interpreting that speech up there. But the user at the end has to figure out the ones that fit best for what he needs and use that to interpret what is going on so he has full comprehension. And we have many different types of indicators. Now, indicators are based on mathematical equations that produce a value that is plotted on your chart. For example, a moving average calculates the average of the price for security in the past and plots it on your chart. Pretty simple. A moving average is the most simple technical indicator. Okay. Now, moving averages can have, not moving average indicators can have involve complicated mathematical calculations, like say Bollinger Bands that uses standard deviation. And standard deviation is the square root of the variance of all the sums of data. It's a very complex statistical formula. Where a moving average just takes if you're using a 20 period moving average, the last 20 closes, adds them together and divides it by 20. In either case, they're then put on your charts. Now, technical indicators, actually, let me pop up a chart here. Technical indicators can be put on your chart over top of price action, like we see here, or down below, like we see here. Okay. Now, in the middle of this, the brown line is a moving average line. Okay, that just goes along price. Okay, the one above, over top, is Bollinger Bands. Down below, we have MACD, which is a specific kind of indicator, and underneath that, in the purple, we have RSI, which falls in the classification of a bounded oscillator. They all interpret price differently, and they work hopefully in conjunction with each other. But you have to understand what the indicators are that you're using, because sometimes people use 3 indicators to give you the same piece of information, and they wonder, oh, everything's giving me a buy, I'm going to buy. They don't realize those 3 are using basically the same mathematical calculations because they're using the same type of indicator. So you have to learn how to use indicators in confluence, but you also have to remember that ultimately the only thing that has any say in anything is price action. Now on this chart, I've added on here Fibonacci levels. Okay, these are these numbers over here. This is an indicator. Okay, let's see if I can change it to fan. Okay, so you see all the red. I just changed them to red. Okay, they're all based on a Fibonacci level, and as price goes up and down, it uses these Fibonacci levels or Fibonacci ratios to predict where prices can go or where price should have a reaction. All of these are technical indicators. But remember, they indicate what we might see happening in the markets. Now, there are 2 main types of indicators. We have leading and lagging indicators. Now, this is not like the teacher calls you and tells you your kid's lagging behind in school. Lagging indicators are not necessarily bad indicators. Okay, they are not meant to be good and bad in indicators. Leading means they lead the market. They're trying to predict what is going to happen. Where a lagging indicator is a confirmation that something has just happened. Because when a trend changes or reverses, you may not see it instantly, but your indicator, your lagging indicator, will tell you it just happened. Where your leading indicator is going to tell you it probably is going to happen now. So leading indicators precede price movement and try to predict the future. Lagging indicators follow price movement and act as confirmation tools. Now, these indicators, whether leading or lagging, break into categories of what they analyze and what they work for. So we have trend indicators. These measure the direction and strength of a trend using some form of price averaging to establish a baseline. Now, I mentioned price. Do you know, no matter what you're looking at in the markets, you only have 5 pieces of information that make up your backbone. You have the open, the high, the low, and the close, and volume. There is nothing else. So every indicator uses the same numeric values. So trend indicators tell you which direction the market is moving in, and if there's a trend at all. They're sometimes called oscillators. Then we have momentum indicators. Momentum indicators help identify the speed of the price movement by comparing prices over time. Well, wouldn't you want to know how fast or slow that price is moving up? Then we have volume indicators and volatility indicators. Volatility indicators tell you how much the price is changing in a given period of time. Don't you want to know if that price bouncing up and down and up and down and up and down and making big moves? Low volatility indicates small moves. High volatility indicates big price moves. So sometimes when the markets are very volatile, you can get in very low and it's going to bounce up to a high very quickly, and you can get profit and get out of the market. And I mentioned volume indicators. Volume measure the strength of the trend or confirm a trading direction based on some sort of averaging or smoothing of the volume being traded. Now, remember, indicators only indicate, but covering more than 5 indicators on your charts is futile. In fact, it's a big mess. I never use more than 3, and I'm not an indicator guy. I very rarely use indicators. I use chart pattern, support and resistance, and trend lines. But that's me. But support and resistance could be considered an indicator. So, but you never want to use more than 5. Never choose indicators that generate the same signals. Always choose indicators that complement each other. Confirm your strategy by using an additional indicator or indicators to substantiate a trend. Now, what I will do now and then, and I like MACD, is use it as a confirmation tool. When I can't really make a decision, I need something to help me, push me. I may look at an indicator as the last result, as a confirmation tool, as a final filter, and say, okay, if MACD says buy or MACD says the market's overbought or oversold, okay, that's enough at this point. And learn what indicators are and why you should choose one indicator instead of another. Like, for some reason, the markets and traders love to use RSI and stochastics. In fact, it was so popular that somebody's even developed an indicator that's RSI stochastics. Well, both of them tell you the same thing. So to find the best technical indicator for your trading approach, test out a bunch of them singularly and then in combination and see which ones work for you. So regardless of whether you're trading stocks, Forex, or futures, it's often best to keep it simple when it comes to technical indicators. You may find you prefer looking at only a pair of indicators to suggest entry points and exit points, and most use only one from each category of indicators to avoid unnecessary and distracting repetition. So you want to avoid redundancy, what we call multicollinarity. And it's a statistical term that refers to multiple counting of the same information. And this is a common problem in technical analysis that occurs when the same type of indicators are applied on one chart. So we want to do everything we can to avoid redundancy. The results create redundant signals that can be misleading. Some traders intentionally apply multiple indicators of the same type in the hopes of finding confirmation for an unexpected price movement. In reality, however, multicollinearity can make other variables appear less important and can make it difficult to accurately evaluate market price. So you want to avoid using the same type of indicators. You want to use complementary indicators. To avoid the problem associated with multicollinearity, traders should select indicators that work well with or complement each other. Knowing what indicators to use and what is the best combination of technical indicators can dramatically improve your trading results and skills and give you better trades. If you use the wrong technical indicators, this can lead you to inaccurate price interpretation and subsequently to bad trading decisions. So remember, they break down the leading and lagging, but they all still fall within those 5 categories. I don't particularly like leading indicators because I don't want somebody to tell me what could happen. I want it to be confirmed with what did happen, but I want to know it as fast as possible. And then indicators can further be divided into 2 categories based on how they're built. Oscillators, which I mentioned before, are about the most popular. Oscillators look like a radio oscillator, but when they're calculated, they always come out between 2 variables, like RSI and stochastics. No matter what happens in the market, they will always come out between 0 and 100, where MACD will come out to whatever the numeric value is, and it's plotted under, sometimes positive, sometimes negative. Okay. An oscillator will always oscillate between 2 numbers, and therefore we can put boundaries in between those and set interpretations. Like when MACD, RSI, or stochastic goes over 80, it says the market's overbought because it's only going to go as high as 100. When it's under 20 or 25, you can say it's oversold because it can only go as low as 0. And then non-bounded indicators are less common, but they still help with buy and sell signals. In fact, I don't know any non-bounded. Well, you do. MACD is a non-bounded indicator. But remember, and always remember, indicators only indicate. An indicator should be a final filter system. They shouldn't be your decision makers. So there are many indicators out there, but there's only a list of 10 that are the top. MACD, RSI, stochastics, ROC, ASX. Okay. You can quickly add those into your trading, try them out. Start with one. If you like, I started originally with MACD because I like the name, Moving Average Convergence and Divergence. But you can start out with just simple moving averages. But use them as your trade filters. Test them out, add more together, and see how you can build a strategy or an interpretation system of the markets to complement your trading decision. So thank you very much for joining us today, and have a great trading week. Bye now.